Welcome to the deep dive. Today, we're really zeroing in on something fundamental for all you future financial planners out there: insurance. Specifically, auto insurance and how it fits into the bigger picture of risk management.
That's right. Think of this as your guide to the key stuff you absolutely need for exams and, for your future practice.
We're basing today's discussion on materials from the CFP education program, Module 11, focusing on insurance, risk management principles, and yeah, that deep dive into auto.
Exactly. We'll unpack insurance contracts, the principles behind them, the whole risk management process, and then really get into the nitty-gritty of auto insurance coverages, terms you got to know, and what actually drives those premium costs.
And we want to make this clear, maybe give you some solid examples to help you really grasp these essential elements. Sound good?
Sounds perfect. Let's jump in.
Okay, so insurance. At its core, what are we talking about? It's basically a safety net, right?
Yeah, essentially, it's a contract.
Huh?
One party, the insurer, agrees to indemnify, that means compensate another party, the insured, if a specific loss happens. And this is all in exchange for a payment, the premium.
So it's like a financial shield for when things go wrong.
Precisely. And like any legal contract, it needs certain things to be valid. Our materials mention offer, acceptance, consideration, legal capacity, meaning both sides are competent to make a contract, and importantly, legal intention. Both sides have to mean for it to be a legally binding deal.
Okay, so how does that usually play out with insurance? It's not like buying coffee, I imagine.
Not quite, no.
Yeah.
It's a bit more structured. Usually when you want insurance, say for your car, you fill out an application. That application, that's generally seen as your offer to the insurance company.
Okay, I offer to buy insurance based on my details.
Right. Then the insurance company looks at your application, assesses the risk, decides if they want to take on that potential cost, and if they agree, they issue the policy. That policy issuance is their acceptance. Offer plus acceptance equals agreement.
Got it. And what about consideration? That sounds like a term we really need to lock down.
Definitely exam worthy. Consideration is what each party gives in the deal. For you, the policy owner, your consideration is the premium you pay.
Okay, the money.
Right. And for the insurance company, their consideration is their promise, written down in the contract, to pay out if a covered event happens. It's that swap of value that makes it all stick legally.
Makes total sense. So who are the key players here? We have the insurer, the company.
Yep, the insurance carrier.
Yeah.
And then we have the applicant, that's the person applying, who becomes the policy owner once it's all set up.
Right.
And here's another absolutely critical concept.
Yeah.
Insurable interest. The policy owner must have an insurable interest in whatever's being insured when the policy starts.
Insurable interest. Okay, let's make sure we nail this. What does that really mean? Give me an example.
Sure. It means you stand to suffer a direct financial loss if the insured thing is damaged or lost, or if the insured event happens. So you have an insurable interest in your own car because, well, if it's wrecked, you lose money.
Okay.
You also have an insurable interest in your own house, your own belongings. For life insurance, you have an interest in your own life, or the life of someone whose death would cause you financial hardship, like a spouse, or maybe a business partner in some cases.
So I can't just decide to insure my neighbor's fancy sports car hoping it gets stolen so I can collect.
Exactly. Because you don't stand to lose financially if their car is stolen. You don't have that direct stake. That's insurable interest. It stops insurance from becoming, a gamble.
Right, prevents weird incentives. So for property and casualty insurance, like cars and homes, who typically has that insurable interest?
Generally the owner of the property. They're the ones who lose out if something happens to it.
Okay. We have the applicant, the insurer, insurable interest. We mentioned the offer and acceptance. When does the actual coverage kick in? Is it the moment they say yes?
Not usually, no. Even if they approve your application and issue the policy documents, the coverage typically only starts once two things happen. One, the policy is actually delivered to you, the policy owner. And two, they receive that first premium payment.
Ah, okay. So policy in hand, first payment made, then you're covered.
That's generally how it works. Those are like the final activation steps.
Got it. Now, besides insurable interest, you mentioned other principles. What about the principle of indemnity? That sounds important too.
Hugely important. Indemnity is the idea that insurance should make you whole again after a loss, but not put you in a better financial position than you were before.
Okay, so it's about restoration, not profit. Can you give an odder example?
Sure. Let's say your car gets damaged in an accident. Indemnity means your insurance should pay the cost to repair it back to its condition right before the crash happened.
Right.
They won't typically pay to make it better than it was Like, they won't put brand new high-performance tires on if you had standard half-worn tires before the accident. The goal is just to compensate for the loss you actually suffered.
Okay, that makes sense. No windfalls from insurance claims. Now let's zoom out. Insurance is obviously a tool. How does it fit into the overall process of managing risk? This seems foundational for financial planning.
Absolutely. Insurance is a key technique within the broader risk management process.
Hmm.
And understanding this process is, well, essential for advising clients. Our materials lay out 5 steps.
5 steps. Okay, what's step one?
First, you set the risk management objectives. What are you actually trying to achieve? What financial security are you aiming for? For a client, it might be ensuring their family is okay financially if they pass away, or protecting their savings from a lawsuit.
Knowing the goal first makes sense.
Step 2.
Step two is identifying and evaluating the risks. What could go wrong? What potential events could cause financial harm? And then how bad could it be? Our sources talk about classifying consequences. Are they dire, substantial, or just minor?
Like losing your house in a fire is dire, but maybe a flat tire is minor? Exactly. You also consider how likely these things are to happen. Once you know the risks, step 3 is selecting strategies to deal with them. This is where we see risk control and risk financing.
Risk control and risk financing. Okay, break those down for us.
Sure. Risk control is about trying to reduce the chances of a loss happening, or lessening the impact if it does. Think installing smoke detectors, that's risk reduction. Avoiding certain activities altogether, like maybe not buying a trampoline to avoid injuries, that's risk avoidance.
Okay, trying to stop bad things or make them less bad. What's risk financing then?
Risk financing is about how you'll handle the cost if a loss does occur. The main ways are risk transfer, which is where insurance comes in, and risk retention.
Ah, so insurance is transferring the financial risk to the insurer?
Precisely. You pay a premium, and they take on the potential cost of that specific risk. Risk retention means you decide to handle the cost yourself, maybe through savings or an emergency fund, like paying for small car dents out of pocket instead of claiming.
Okay, control, transfer, retain. What are the last 2 steps in the process?
Step 4 is implementation, actually putting the plan into action. Buying the insurance, setting up the emergency fund, maybe installing that security system. The planner helps the client do this.
Doing the things you decided on.
Right. And finally, step 5 is crucial. Monitoring and review. Things change, client's income, family situation, assets, even the risks themselves. So you have to revisit the plan regularly, maybe annually, to make sure it's still doing its job.
Yeah, definitely not a one-and-done thing. Okay, let's dive deep into auto insurance now. The materials suggest it's often more complex than, say, home insurance. Why is that?
A big reason is regulation. Unlike home insurance, where you mostly decide your coverage levels, auto insurance is heavily regulated by each province and territory. They mandate certain minimum coverages and amounts that every driver must have.
So the rules are different depending on where you live in Canada.
Significantly different in some cases. What's compulsory in Ontario might be different from Alberta or Quebec. The minimum liability limits, the types of accident benefits required, it all varies. So you really need to know the rules for the specific province you're dealing with.
That's a key takeaway for students, for sure. Okay, let's get into some essential auto insurance terminology, stuff we definitely need to know for exams. What are some key terms?
All right, first up, legal liability. That's your responsibility under the law for any injury or damage you cause to others while driving.
Okay.
Then there's negligence. This is often the basis for liability. It basically means you failed to be as careful as a reasonable person should have been in that situation, and that failure caused harm.
Like texting while driving and causing a crash.
Exactly. That could be considered negligent. Then you have named insured. That's simply the person listed on the policy, the owner. A third party is anyone involved in an accident who isn't you or your insurer, like the driver of the other car.
What about absolute liability? That sounds strict.
It is. It means liability can be imposed even without proving fault in the traditional sense. The example often used is if you knowingly let someone drive your car, even though their license is suspended, and they injure someone, you, the owner, could be held absolutely liable.
Oof. Okay. And no fault. That term causes confusion.
Yeah, no fault refers to systems where your own insurance company pays for certain benefits, like medical costs or lost income, if you're injured in an accident, regardless of who caused it. But, and this is critical, what no fault actually covers and how it works varies wildly between provinces. It doesn't mean nobody's ever at fault legally, especially for vehicle damage or more serious injury claims.
So Got to know the provincial specifics. One more term. Deductible.
Right. The deductible is the amount you agree to pay out of your own pocket for a covered loss before the insurance company starts paying. You choose your deductible amount, usually.
Got it. Okay, let's talk coverage types. Bodily injury seems like a major category. What falls under that?
It's huge. First, there are accident benefits. We touched on this with no fault. These benefits cover you, your passengers, and pedestrians injured in an accident involving your car, typically regardless of fault.
And what kind of things do accident benefits cover?
It varies by province,
Yeah.
but generally, things like medical and rehab costs not covered by provincial health care, funeral expenses, potentially income replacement benefits if you can't work, and maybe death benefits for dependents.
So it provides that immediate support for injuries. What else protects against bodily injury?
Uninsured motorist coverage. This is vital. It protects you and your family if you're injured by someone who illegally has no insurance or by a hit-and-run driver.
So even if the other driver breaks the law by not having insurance, you still have some protection.
Exactly. It helps cover your injury-related costs in that awful situation. And then there's third-party liability coverage, which we mentioned earlier.
Right. This covers damage you cause to others.
Yes, if you're legally liable for injuring someone else or damaging their property with your vehicle, this is usually mandatory, and choosing a high enough limit is really important. If a claim against you is bigger than your limit, you could be on the hook personally for the rest.
That's a scary thought. Definitely need adequate liability coverage. What happens if you're driving someone else's car? Say, borrowing a friend's car.
Good question. The term often used is temporary substitute automobile. If you're driving a car you don't own temporarily, like your car's in the shop, and you have an accident, the insurance policy on the car you're driving, the owner's policy, is typically considered primary. It pays first.
Ah, so the car's insurance follows the car generally.
That's the usual rule, yes.
Yeah.
Your own policy might offer secondary or excess coverage in some situations, but the owner's policy is the first stop.
Okay, clear. Now, what about damage to your own vehicle? What coverages handle that?
Two main ones here: collision coverage and comprehensive insurance. Collision pays for damage to your car resulting from, well, a collision hitting another car, a pole, a curb, rolling over.
Does it always make sense to have collision?
Not always. It usually has a deductible, and the premium adds to your cost. If you have an older car with a very low market value, the cost of collision coverage plus the deductible might mean it's not worth paying for. You might decide to self-insure or retain that risk.
Okay. And comprehensive, what's that cover?
Comprehensive covers loss or damage from things other than collision. Think fire, theft, vandalism, hail, falling objects hitting an animal, glass breakage, that kind of stuff.
So comp covers almost everything else that isn't a crash.
Pretty much, yeah. It also usually has a deductible, often different from the collision deductible.
Our sources also mention all perils and specified perils. Are those common?
There are options. All perils usually bundles collision and comprehensive together and might cover a few extra things like theft by someone in your household, perhaps. It's generally the broadest physical damage coverage. Specified perils is narrower. It only covers losses from specific risks named in the policy, like maybe just fire and theft. It's usually cheaper, but covers less.
And are there common add-ons people get for vehicle damage?
Yes, a couple of popular ones are endorsements like waiver of depreciation. If you have a new car, this can be great. If it's totaled early on, this endorsement means the insurer pays out closer to what you originally paid, not just the lower depreciated value.
Oh, that could save a lot of money on a new car.
Definitely. Another common one is loss of use coverage, sometimes called rental car coverage. It helps pay for a rental car or other transport while your car is being repaired after a covered claim.
Very useful. Okay, let's switch to the cost premiums. Why do some people pay so much more than others for auto insurance? What factors are involved?
It's complex, but premiums are all about assessing risk. Insurers look at a whole bunch of factors. We can group them into driver factors, vehicle factors, and policy factors.
Okay, driver factors first. What about the driver matters?
A lot. Where you live is huge. Urban areas generally have higher rates than rural areas due to more traffic and theft. Your driving record is critical accidents, tickets, they all push rates up. Experience matters too. Newer drivers typically pay more. Then there are things like age, sometimes sex, and marital status, based on statistics. And how you use the car commuting daily in rush hour costs more than just occasional pleasure driving.
So my driving habits and history are key. What about the car itself?
Big impact. The car's value is a starting point. More expensive cars cost more to replace. Repair costs matter too. Cars with expensive or hard-to-get parts cost more to insure. And the type of car, sports cars, often have higher premiums than basic sedans because statistically they might be driven differently or be stolen more often.
Makes sense. And finally, how do the choices I make on my policy affect the price?
Directly. Your deductibles are a big one. Choose a higher deductible for collision or comprehensive, and your premium for that coverage will usually be lower because you're agreeing to pay more yourself if there's a claim.
Okay, higher deductible, lower premium.
Generally, yes. Also, your liability limit. Choosing a higher limit, like $2 million instead of $1 million, will cost more, but gives you more protection. And simply deciding whether to buy optional coverages like collision and comprehensive obviously affects the total price.
So lots of variables there. It's about finding the right balance of coverage and cost. Lastly, claims. What should we know about making an auto claim? When do you have to report an accident?
You should always report an accident to your insurer promptly if you might make a claim or if someone else might claim against you. Plus, there are legal requirements. In most places, you must report accidents to the police if the damage seems to exceed a certain dollar amount, or definitely if anyone is injured or killed.
Okay, so notify the insurer and potentially the police. Are there deadlines?
Yes, policies usually specify time limits for reporting the accident and submitting the actual claim details. Miss those, and you could jeopardize your coverage. Check your policy.
Good advice. Anything else about claims? What's this betterment thing the materials mention?
Betterment. This goes back to indemnity. If a repair makes your car significantly better than it was right before the accident, maybe they had to replace old, rusty parts with brand new ones, the insurer might argue that you've been bettered. They might ask you to pay a portion of the cost representing that improvement so you're not ending up ahead financially.
Interesting. So they pay to restore, but not necessarily to upgrade for free.
That's the idea behind it, yes.
Wow. Okay. We've covered a tremendous amount today. From the basics of insurance contracts, insurable interest, indemnity, through the risk management process. And a really detailed look at auto insurance coverages, terms, premiums, claims. This feels like a really solid grounding for students.
I hope so. And remember, for everyone listening and studying, understanding this isn't just about exams. It's fundamental to giving good advice as a financial planner. Helping clients protect themselves against these kinds of risks is a core part of the job, and auto insurance is relevant for almost everyone.
Absolutely. So, a final thought to leave you with. We talked about today's auto insurance, but think about the future. With self-driving technology, electric vehicles, ride-sharing, how do you think auto insurance principles and coverages might need to change or adapt in the coming years? Something to chew on.
Definitely a fascinating question. We hope this deep dive has been helpful and clarified these important insurance concepts for you. Good luck with your studies.